looking for. Our next session today is on financing the growth engines. Let's quickly introduce our session chair, Mr. Farooq Shahab, the Chief General Manager, State Bank of India. He has more than 3 decades of experience in the banking sector, covering retail, corporate, international banking, helming internal audit functions of SBI and experience in L&D space. He helmed SBI's Karnataka operation, comprising of more than 1,900 branches, 20,000 employees, and business volume of US $23 billion. He also led the smooth merger of State Bank of Mysore, State Bank of Hyderabad, and State Bank of Travancore with SBI in the state of Karnataka. He also registered highest loan book growth among peers. Who can be better than him to take us through this session on finance? Over to our distinguished moderator to introduce the speakers and tell us where to get the money from.
It has led into technical recession, 2 consecutive quarters back on back. We are degrowing, GDP is degrowing. But the recent festive season that has shown some green shoots, but the cognoscenti are in the wait and watch mood whether this green shoot are going to sustain or not. So there is a mood of despondency as of now among the financiers, among the bankers, and all those. And it is the time when general climate is slightly despondent. Such kind of events, it brings back your animal spirit. It lifts your mood, it lifts your morale, and such events don't only lead into creating buzz, but also gives ideas, and they also help us collaborate with each other and look into the future with confidence. Theme of the summit is taking gross state domestic product of Tamil Nadu 15x by 2050. Tamil Nadu has a history of more than a decade's history of growing at 8%, around 8% GDP year on year. Leave aside this washout year of 2020, hoping to take this GSDP growth rate to 12%. On the face of it, may appear challenging, but if we think that what are the opportunities available, I think that you will also notice that after all, it's not that great difficult. Only thing is that how much enabling environment can be created. Previous session was very interesting on reimagining education. It was very relevant topic. what distinguishes between a job seeker and an entrepreneur? Apart from skill sets, what I'll say is that their dreams and their appetite for risk. These two things are very important. Entrepreneurs have to dream big and chase their dreams. So here comes the theory of this 15x by 2050. Such events definitely will bring positivity, ideas, and forging of collaborations. Over the past 2 days, several speakers, experts in their own areas, spoke on so many aspects of development. But one thing which I noticed, which was very common in all the speakers' views, was the confidence in Tamil Nadu. Their belief in Tamil Nadu, that was very important. So, is that where from this confidence, this belief in Tamil Nadu comes? This comes from the fact that it is one of the most highly industrialized state, more than 37,000 factories, and probably Tamil Nadu state is the one which has got most number of, among all the states, most number of operating SEZs, special economic zones. I mean, my data say that we have in Tamil Nadu presently 55 SEZs which are operational. That is a great thing. And of course, Tamil Nadu is known as Detroit of India with its automobile sector. 3 cars per minute. Tamil Nadu produces 3 cars per minute. And 1 truck per 2 minutes. 1 motorcycle every 6 seconds. So it is such a great thing to be associated with this event, which is imagining Tamil Nadu as a happening state, as a state which is there to take up the challenges of future and of course to contribute to the India's economy. And of course, this Manchester of India, Tirupur, although I know that Tirupur sector, which is very much known for textiles and garments, it's facing its own challenges. It's facing its own challenges because of Sri Lanka, Bangladesh, and all those. But again, Tirupur can also be reimagined how to overtake these other emerging textile exporters. Tamil Nadu's more than 1,000 kilometers coastline, that is also a very great advantage. It has 7 airports. I don't think that many of the states have so many of functional airports, and 120 aerospace units. Its young population, it's a strength. And on social sector, 24 universities, more than 1,000 engineering colleges, 560 ITIs, 500 polytechnics, 9 medical colleges. So, social sector is also very much geared. So social sector is also very much geared towards helping out Tamil Nadu. Another important development that I've noticed is the emergence of knowledge economy in Tamil Nadu. Knowledge economy, after all, what it is? Knowledge economy is where you create wealth from your brain and not from the sweats of your eyebrows and muscles of your legs and arms. Chennai is today known as SaaS capital of India, software as a service capital of India. There are around 1,200 SaaS enterprises which have come up recently over the past few years in India, and NASSCOM says that about 1/4 of them have come only in Chennai. And those SaaS enterprises have created a revenue of more than $1 billion for Tamil Nadu. Reasons for such SaaS enterprises is not very far away to see, is that one thing is that Chennai has a very vast and large student community, which is all energy, and they're bustling with energy. They want to do something. And as I told you, there are 55 SEZs, and out of those 55 SEZs, I am told 18 of the SEZs are in and around Chennai only. So these SEZs they provide opportunity to these startups to breathe easy, because they find it difficult in an atmosphere which only speaks of the traditional industry. The ecosystem itself is very helpful. I think that one of the reasons is that Chennai has great facility for startups. Yeah, Deshpande Foundation's professor was telling IITM Research Center is there. IITM Research Center is incubating many entrepreneurs and all those. And there's a startup center, another startup center is there. There's PayPal Start Tank. Anna University is also incubator. So Chennai has a perfect environment to blossom as a major hub for all things technology. So this is what is my. These are what are my initial thoughts on the issue. In this connection, I had a talk with because is that any development, especially India as an economy is fund-starved, capital-starved economy. So it needs huge capital. So as a part of UF initiative, one of the international banker, international fund manager, international insurance person, Dr. James P. Bond, who has World Bank, who has experience of working in World Bank. He was MIGA's country representative in African countries and all those. So I had a small talk with them. So in regard to what the international money, what the international investors, what the global investors look into an investment destination, and what are the things which come in their way which puts them off. So I'll request the admin to kindly show that clip, because Dr. Bond is stationed in Washington, so we couldn't bring him live. So it was a chat by fireside. So I'll request the admin to kindly show the video clip of that interview, and then we'll start introducing the speakers. We have a very eminent panel of speakers here, so they'll be speaking. They're sharing their thoughts on the issue.
Global financial services is valued at a massive $22 trillion in 2019, underlining its importance in financing growth around the world. Given its inherent risks and large socio-economic impact, it is often among the top policy agendas for all governments. A strong financial system broadens access to finance to everyone and aids in the development of medium and small-scale enterprises, and that results in higher income generation. For a developing country like India, a robust financial system is essential. India's financial sector is predominantly banking, with 96,000 rural cooperative banks, 12 large public sector banks, 22 private ones, 56 rural, regional, and about 1,500 urban cooperative banks, representing 64% of the total financial assets. India lags behind developing countries, with its credit to GDP at only 51%, much lower than other countries like China at 164%, Japan at 174%, and the US at 192%. Insurance has been an additional source of financing for India. 50,000 crores was invested in 2019 alone. Tamil Nadu alone, on a conservative basis, requires over $100 billion for financing its growth over the next 10 years. Potential sources of funding for Tamil Nadu are obviously the banking sector, FDIs, development financial institutions, as also Gulf countries' sovereign wealth funds, who hold a colossal $3.3 trillion. In the pursuit of 15 times GDP growth for Tamil Nadu by 2050, financing will play a pivotal role in supporting socio-economic development in the state and underpinning future economic prospects. The growth engines need fueling.
Yeah, thank you, Tawfiq, for such a nice introduction. Thanks a lot. And now this is the opportunity to host James Bond. In fact, James P. Bond. He is the other very famous Bond. Only thing is that he doesn't work in movies, but yes, he works in the financial world. He's a senior managing director at Blue Monsoon Capital and a key member of the senior executive team based out of Washington. He has a considerable experience, very lengthy experience in World Bank bodies, including he was chief operating officer in multilateral investment guarantee agency. He is basically a risk and finance professional who has a global perspective on what takes finance from one shore to another shore, and how investments are made, and what are the considerations of investors whenever they are making investments in different geographies. So his presence and our discussion with him, I hope that will be of great benefit to the audience here, because as you know is that Tamil Nadu, as also entire India, is a very huge consumer market. It's ready to consume. Consumption appetite is very huge, and we need investments. And our goal is that whatever is the annual growth rate, we have to make it 1.5x. So welcome again, Mr. Bond. I'll address you, if you permit me. I'll address you at James. And I hope that everyone will enjoy our interaction. It's very nice, good to talk to a fellow finance professional who is expert in risk area especially, and who is very good to provide us with the global perspective as India as an investment destination. James, as you are aware, is that India, like any other emerging country, is capital-starved, fund-starved country, and it has huge consumption potential, both in consumer durables and services and all those, which is evidenced by, say, huge import bills on so many consumer durables, non-oil import of India, and also tremendous success that these e-commerce companies are making here. So now there are two issues, is that there already such a big market is there. So investment, although, is that India has been doing very well. 2019, India recorded the highest ever FDI, foreign direct investment here. But with this COVID and all those, we are apprehending that there could be a 40% downfall in that. Now, first of all, is that I'd like to understand from you that India as an investment destination, how is it perceived globally?
So,
yeah.
So, Farooq, first of all, thank you very much, and a good evening to you. I'm very happy to be here. Very happy to participate in the UEF conference. So, India is the third biggest economy on the planet. It's a big economy. We're not talking about small. It's the size of a continent in terms of the economy, in terms of population and the like. And you're absolutely right. What's particularly attractive in India is this enormous potential market. It's as though you were a European Union on your own. You have this enormous market with huge potential. And you're absolutely right that the issue here is financing the production to service that market. Basically, finding the investment to be able to create the productive capacity to get the growth up. And I think that is a challenge that all emerging economies go through. But India, in some ways, has a much bigger advantage over some of the smaller countries. You don't have a scale problem. So you have this advantage. You have tremendously good human capital, both real and potential. You have some of the best innovators on the planet. If you go to California, half of the people running these startups are Indian, the other half are Chinese. So I mean, it's a huge potential. But how can we harness these for growth in India? And I think that we have to also look at some of the disadvantages, which for the most part tend to be self-made. And these are things that can be overcome at a regional or local level. So The first is India is perceived still today, and I think not completely fairly, but it's still perceived today a little bit as the permit large. So it's a country where it's quite difficult to do business if you're not India, because it's a complex, it's arcane, and there's a lot of rulings, a lot of internal regulation that becomes a little bit difficult for investors really to grapple with. So that is one thing, and that's something that can be done very effectively, as Chennai has done in the past, at creating, if you like, your own little island of let's say, business-friendly area, similar to Dubai did this with the DIFC. Chennai has done this in the past. Hyderabad has done it. But I think that this is the first thing. You have to create an environment which is attractive to investors. The other thing is that investors want to come in and want to create factories, or whatever, production capacity, but they have certain costs to be borne. And these costs relate to the environment in two important ways beyond the question of the regulatory environment. The first is infrastructure. Is the electric power suitable? Is it good quality? Or do they have to themselves put in backup generators? Are there roads to the ports? Are the ports big enough? What's the cost to get a container out of the port? So the second is really this infrastructure, getting effective infrastructure that really reduces the costs of investors. This makes a tremendous difference. And we see this in places like Malaysia with their export processing zones and the like. And then the third is something that I know that you and the UEF have done a lot of thinking about, and that is the skill set. What are the skills available in the workforce? Now, I would say all three of these, the regulatory environment, the infrastructure, and the skill set, are things that it's difficult to really know quite what's needed unless you work with the potential investors or with the private sector.
So, as I understood from you, one thing what is of concern is navigating the bureaucratic and political, so to say, minefield in Indian market is...
Well, for foreigners, not for Indians, it's understandable.
Yeah.
But for people, it can be daunting.
Yeah. And second thing you are telling is that effective infrastructure should be efficient, and that is one of the. Third thing you pointed out is the deficit in a skill set. I mean, there's quite a large number of people who are ready to work in all those, but they are deficient in the skill level. Yeah. These three things you said. So regarding the regulations and all those, what I'll say is that recently this World Bank Ease of Doing Business Index had come up. So in that, India has improved 14 steps, from 77 to 63. So do you think that it will be of some help?
So let me give you a little example. So if we took one small small city or town in India, we plunked it down in the Indian Ocean, we allowed it to do, with Indians, and we allowed it to do what it wanted to do, what would happen? Well, this has actually happened. There's an island called Mauritius, which has Indian population, which has very close links to India, but they have been able to work on these three things. And they are way ahead in terms of, because it's in the 60s, they're kind of, I think, number 32. And I think that India should be ambitious in terms of what you can achieve on the regulatory front. And perhaps not even India, perhaps you could do this at a regional or a state level. There's no reason why Tamil Nadu couldn't be, if you like, in the vanguard of Indian states in terms of regulatory environment, in terms of infrastructure and the like. So I would say you don't have to necessarily think we need to be ambitious at the India level, but we can also start that ambition at a specific state or even a city area.
So, okay, another thing, is that I'd like to understand from you is that one thing is recently India was downgraded by international rating agencies, and now it's just barely investment grade. How do you think it will impact FDIs to India?
Well, the FDI, in a way, the FDI, there are two real kinds of FDI. There's FDI that goes into factories. It's kind of sticky. It sticks around because you can't move the factories. Yeah. And then there's FDI into what we call portfolio investment, which is essentially buying shares on the Mumbai stock exchange. That's very fickle. It'll come and it'll go, and it will depend on things like ratings and this kind of the like. The first, though, is really much more focused on the underlying, let's say, interest for investor, the return for investor to invest in India. And I'd say that India has such fantastic opportunities and such fantastic assets, a large market, very well educated elite who can manage these things, innovative. And I think that this will always attract investors. If we can kind of focus on making their life easier in terms of navigating the regulatory, let's say, process, then they will come irrespective if you get downgraded to the top end of, speculative. I mean, it's obviously good to have the best rating you can, because ultimately the cost of capital flowing into India will depend on that rating. The lower the rating, the higher you'll pay, but it may not affect that much those who want to invest in assets and hard assets. It's really going to affect more those who invest in portfolio investment in stocks and bonds. Just to give you a figure, world GDP is about 140 or 150 trillion dollars. That's a lot of money. And financial assets are about $300 trillion, twice GDP. Of that, just investment funds were $89 trillion. And these are people investing in this country, in the US, they're investing in Europe, they're investing in, if you like, because they are risk averse, they don't like risk. They are looking at India, and some of the more adventurous ones are going into India, but they are asking for the kinds of returns which I honestly think you should be able to get to do better than that. So the question is, how do we make the other more risk-averse guys come to see India as a low-risk jurisdiction? And I think that that's the pot of gold at the end of the rainbow. If people could say, India, safe. I'm not going to invest in Turkey anymore. I don't know what's happening. It's really gone weird. Latin America for the moment. Argentina's defaulting again. Africa generally. I don't want to work in Nigeria, and South Africa goes up. But what about India? Now we have an economy. So I think India, everywhere else is actually going through a pretty bad phase at the moment. China, which used to be the premier destination for foreign direct investment, has suddenly got a lot less attractive for American investors. Latin America, which was on a roll 5 years ago, no one wants to invest there because they're going through the big problems. Turkey, which was the poster child of merging in. So this is India's opportunity. India is, if you like, the only major, significant, advanced emerging economy that's still in the playing field. And I think the time now is to be quite aggressive and to go out and to say, we were open for business, we're even more open for business, come to India. Now, for Tamil Nadu, I think, should really think as being, if you like, the Hong Kong to India that Hong Kong is to China. To be that sort of island of high innovation, of being out there ahead of things, about being more dynamic, about being India plus, if you like. And I think there's a real opportunity to zero in on very high value added areas. You have the manufacturing, the services, and the like. So I think Tamil Nadu, the 1.5 times Indian growth, I think is doable. But it does need to differentiate compared to India and to compare to the other jurisdictions that are trying to do the same.
Yeah, thank you very much. Thank you very much for showing this video clip. And my panelists, Mr. Tyagarajan and Mr. Rafe Hanif, both are here. So they have already understood that one of the international banker, I should say international risk professional, who looks keenly on how funds flow from one shore to another, he has shared his opinion on how global investors look at India as an investment decision. So I have the privilege of introducing Mr. Tyagarajan. Mr. Tyagarajan is lawmaker in Tamil Nadu's assembly. He has a very inviolable international banking career when he worked with the Standard Chartered Bank and also in the famous Lehman Brothers. He's deeply rooted in Tamil Nadu and has an incredible understanding of Tamil Nadu's developmental needs. So he will be sharing his thoughts on what are the developmental needs of Tamil Nadu, and also that what the Tamil Nadu expects from entrepreneurs, and how he can, as a lawmaker, facilitate more and more of investments coming up in Tamil Nadu. A few issues which I like him to address, is that what Mr. James Bond was telling, infrastructure. We all know that India has improved manifold in the field of infrastructure, but is still probably global investors not very happy with the pace of this infrastructure building. So how we can step up this pace? Second, is that a skill set. Although we were telling that we have more than 1,000 engineering colleges in Tamil Nadu itself, and more than about 24 universities, so many ITIs, so many polytechnics and all those, but still he was kind of telling that global investors not very happy with the skill set that's available in the market. So that's also one of the issue. Third issue, despite the fact that India has improved 14 steps in its east to do business and all those, I think that Tamil Nadu is also improved probably 1 or 2 steps in its own state level ranking. So what can be done to sort of this regulatory and political issues, what he was flagging, how we can bring it down? Although I know that I have so many business contacts. I mean, I have contacts with so many industrialists in Tamil Nadu. They say that Tamil Nadu especially, so far business is considered, it's very bipartisan politics. I mean, either side of the political divide, whichever is in government, they always promote business and without any kind of rancor for any particular group and all those. So that is one of the very wonderful things which I have been hearing. But again, maybe Mr. Tyagarajan can give his opinion on that. And after this chit chat was over, is that I was just, which was not recorded, I was talking to James. Then James was telling he has worked with, he was World Bank, so Joseph Stiglitz, the famous Nobel laureate in economics, he was his colleague. So Joseph Stiglitz had recently come to India, and he was telling, he told in, without mincing his words, he said that if discord among communities continue, nothing will happen, nothing will work in India. I mean, he was telling this in the matters of economic development only. So over to you, Mr. Tyagarajan. Thank you very much to you for sparing your valuable time for all the delegates here. Over to you, sir.
Thank you, sir. Okay, can you hear me?
Yeah.
Okay, great. First, my thanks to Mr. Ahmed Buhari and to the forum for inviting me and giving me this great opportunity. I'm also very grateful for the kind introduction. I almost felt like I was hearing myself speak when I heard Mr. Bond. And again, the world of finance is still a relatively small community. And I'm also only about 1 degree separated from Mr. Bond, because my colleague Madeline Antonsek, who I worked very closely with at Lehman Brothers, was the treasurer for the World Bank for much of the time. She overlapped with Mr. Bond. So, almost everything he said is like gospel to me. It's what I know of finance. It's what I've read in the textbooks. It's what I've seen practiced in my decades in both investment banking and commercial banking, in advanced markets and emerging markets. So if I could maybe just in 5 minutes look at it slightly different perspective, not as a development bank guy, but as an ex kind of for-profit banker and now a lawmaker, I would say that the structural problem in India is very clear. Because we don't have as robust democratic institutions and resolution processes, we do not have the scale of debt markets that we ought to have. That is the fundamental, profound problem, because banks are not supposed to be in the business of long-term infrastructure type project financing. And as everybody knows, without building the infrastructure, you cannot build the superstructure. So if you do not have the roads and the bridges and the ports and the drinking water systems and the highways and the industrial estates, you are not going to increase production. Unfortunately, the statistics Mr. Bond's video put out, or the UEF video put out, which shows our credit to GDP, not only is it so low, it has actually slowed significantly in the last few years. The rate of credit growth has dropped dismally. Back when I was a Standard Chartered, when we used to do our strategic planning, our allocation of budgets was a rule of thumb that whatever the GDP growth rate we expected credit growth would grow twice of that, especially in emerging markets where access to equity capital is limited. So in that sense, the problems of India's structural constraints, the lack of debt markets, the excessive hand of the government in the banking system, and the lack of timely dispute resolution through a judicial model are becoming exacerbated, more evident every day, and are really the major bottlenecks. And at some point, unless we can fix those, I worry that we are tinkering at the edges as far as the country is concerned. As far as Tamil Nadu is concerned, as many have pointed out, we're in a completely different league than the country average. The statistics that I would say, being roughly 6% of the population, we're about 10% of the GDP. Yes, we have very high educational outcomes. Over 86, 87% of our population graduates high school. Average education is a high school graduate. And something like 48, 49% of our youth of college-going age enroll in higher education. And that's by far the number one in India of any state. Of course, one could argue that the quality hasn't kept up with the volume, but given that in 2 or 3 generations, when I graduated from the National Institute of Technology in Trichy, the state of Tamil Nadu produced about 3,500 engineers a year. It now produces about 160,000. So you have to start somewhere, and I suppose starting with volume and then eventually cutting down to improve quality, which is happening. Engineering colleges are closing every year, is not a bad outcome. And the biggest, I would say, value add to Tamil Nadu, as somebody has pointed out, actually both of you have pointed out, is the consistency of public policy. And now I'm going back all the way to the Justice Party governments under Dayaki in the 1920s. From then till today, including the 30 years or so when non-Dravidian governments, when Congress governments were running the administration, it is very clear that the Congress parties of the Madras Presidency and Madras State hewed much more closely to the Dravidian line of social justice, inclusive growth, education for all, compulsory kind of elementary education, noon meal schemes, investment in human resources. And so our greatest asset when we link governance and development is that we have had remarkable consistency in our governance and in our political framework and in our social structure, or the way we envision how we want our structure to evolve. And you can see that going back to, the policies underlying, but even to things like the SIPCOTs, the LCOTs, the TIDCOs, the TIICs, the industrial estates, the organoms, that may have gone faster or slower at different governments, but irrespective of which party was in power, the consistency of always moving forward on these initiatives, I think, is a testament to why we have been able to achieve these outstanding outcomes relative to the rest of India. Having said that, I must say that the last 10 years have been a bit disappointing statistically. Our economy as Tamil Nadu, our GSDP, about 25% of it was related to manufacturing in the year 2011. That has dropped to about 20%. We used to account for about 11.5% of India's total manufacturing capacity. That has dropped to about 9%. So over the last 10 years, we have declined. The reason for that decline is not very hard to find. Till about 2011, just as one indicator, Tamil Nadu used to allocate about 2.5% of its GSDP towards infrastructure or capital spending in its annual budget. That has dropped to about 1.25%, 1.5%. This year it will be closer to 1%. So it's not, rocket science. It's basic fundamental economics that if you do not invest in infrastructure and you do not provide the kind of environment for investors to come, then you're going to see your growth stall and you're going to see a bit of a slowdown, and you can't keep up the pace of the past. So I would just conclude my initial remarks by saying that certainly many of us recognize these issues. As a lawmaker, these are issues that I have raised in the assembly. My speeches are in the public domain. I have discussed such things as debt to GDP ratio, as interest as a percentage of revenue, as capital investment and the rate of growth, as the consequences of lower capital investment being seen in lower growth today. And so I think at least the nature of the discourse in Tamil Nadu across all political parties is going on the right track. As somebody who spent a decade on Wall Street and then a decade in the kind of emerging markets, I am very clear, and I'm with Mr. Bond, that there is, there always was way more capital and investment looking for opportunity than there are good opportunities, and that has become doubly and triply so ever since the global financial crisis, when all the central banks have been flooding the markets with liquidity, and there's just so much excess liquidity looking for opportunities. And because of the lack of real growth and real assets, what we are seeing is financial assets being driven up in price and real assets in emerging markets being driven up to unsustainable levels because of investment flows into non-productive real assets as opposed to productive assets or financial markets in a way that matches like a PE ratio. So with this, I would say that the need of the hour is very clear. In my mind, we need to make the environment significantly more attractive and more predictable. Investors understand that there's always risk. There is no return without risk. And, that's my 20 years of experience from serving the biggest funds of the world, from the WAMCOs and the PIMCOs and the AIGs and the Black Rocks and all other asset managers, down to seeing the foreign fund flows who come in, want to set up a factory in Oragadam or in Sri Perumbudur industrial estate. So how do we provide this? How do we facilitate this? And how do we ensure that they have comfort? And I think the 3 or 4 easy steps, or not easy, but clear steps that need to be executed at a state level beyond the structural problems of India, are that we should improve significantly the land administration model and thereby make it much easier for land acquisition and consolidation and the creation of kind of adequate real estate for project development. In my mind, we need to significantly improve the government's own finances, because that sets the kind of base rate for the credit risk of the state. In many cases, the state's own finances have been terribly mismanaged for the last 10 years. Our debt to GDP ratio pre-COVID had risen from about 15-16% up to almost 25%. The interest to revenue ratio had gone from 11% almost up to 20%. These are things that are structurally bad. We need to fix these. And if we cannot fix these, we cannot do the actual step that is directly impactful, which is to improve the investment to GSDP ratio, which, as I say, has dropped by a whole point or a point and a half in the last 10 years. We also have to create innovative financing solutions. Those, I think, are the easiest to do. I mean, if we have professionals who understand the nature of financing during a glut in liquidity and money supply, with the right kind of entrepreneurs and the people who have the links to the financial market centers, be it starting with the Mauritiuses, the Middle East, the Singapores, all the way to the big financial centers of the world in New York or London or Frankfurt or Tokyo or Hong Kong, then, I think all investment is about creating the comfort for people to evaluate risk and return with some certainty. We're all playing this kind of perpetual machine when it comes to the world of finance. And most people understand that there are no black and white or deterministic outcomes. It is the lack of a framework. It is the lack of a range of outcomes where you start saying volatility is so high that anything could happen that starts retarding investment. And certainly the quality of governance, the quality of policy making, the understanding of the true bottlenecks to bringing that comfort and peace of mind to investors. These are the things that a government or a political party can focus on when it comes to power to improve the prospects for investment and investment-led growth, and to look for job creation, which is our ultimate aim, is not just growth that is uneven, but growth that creates opportunity for all segments of society. And that is something that has sustained Tamil Nadu relatively well for a century, despite the last decade or so of decline, relative decline. Still far better than the Indian average, but relative decline. So I thank you for that opportunity, and I'll conclude my comments now. And maybe if there are questions, we can come back later. Thank you.
Thank you very much. Thank you very much, Mr. Tyagarajan. So the two things, one thing is that after Mr. Rafe Hanif speaks, we can have a Q&A, or if you want Q&A right now. Our program is basically Rafe Hanif will first speak, and then we can have a Q&A. Okay, sir?
Yeah, absolutely, sir. I'd like to hear what you have to say.
Thank you very much. So thank you very much for your very, what I should say, is that talking to you, Mr. Tyagarajan, was as if I'm talking to a fellow banking professional. So, our communication, the language that we speak, the language we understand, it's all same wavelength. So there's nothing as if I'm talking to a hardcore politician. Is that world, international banking, the problems that is being faced within India by the banking sector, finance sector. Debt market is not developed, you spoke of, and that's very true. Dr. Rangarajan was trying, Dr. Raghuram Rajan was trying, and he has worked very hard to see that the bond market and all those things could develop. But unfortunately, still bond market is in very nascent state, and funding infrastructure and all those from savings bank and term deposits, fixed deposits of 2-3 years longevity is very difficult. That we all understand, as bankers we all understand. But our PF funds also are not playing that kind of role what PF funds are playing elsewhere in the developed economy and all those. So I hope and wish that with your kind of leadership emerging in the state of Tamil Nadu, and maybe tomorrow even at the national level, probably things will be rosier, much better, and the need of the economy will be addressed in a much more effective fashion. Thank you very much. Now I have the privilege of introducing Mr. Rafe Muhammad Hanif. Rafe is very hardcore banker. He has graduated from Harvard with a law degree. He is an avid watcher of global fund movement, fund flow, how fund flows from one sector to another. He is presently CEO of Group Islamic Banking at CIMB Malaysia. He has his associations with Tamil Nadu. I leave it to him to explain that what kind of association he has with Tamil Nadu. Mr. Tyagarajan has already spoken about what is all that is needed for Tamil Nadu and India in improvement of its governance structure, in seeing that how funds come for infrastructure and all those. So I'll request with his background, Rafe is the most suited to speak on funding aspect of developing Tamil Nadu, especially, and he can speak on India also. There's no issue on that. Especially what I'll say, Rafe, that, is that recently, if you are tracking Indian news, so there was one Ponzi scheme, IMA Ponzi scheme in Karnataka. One Mr. Mansoor Khan had promoted it, and probably he could generate about 5,000 crore rupees, and he defaulted. Is that it was basically on Islamic banking concept, interest-free banking, because in India you have a very around 15-18% of the population is Muslim, who are averse to interest. So with these kind of cheaters also, what happens that they get cheated. And so about 5,000 crore rupees of poor citizenry of India has thus been marketed by this Mr. Mansoor Khan. He is behind bar, government's taken action. There was another recent case, I mean, back to back, one Nahira Sheikh, she also, this Ponzi scheme, she also introduced, and she's also said to have, she is also behind the bar, and she is also said to have mobilized around 4,000 to 5,000 crore Indian rupees, depriving so many lower middle class, poor class people in their chase of interest-free income, in their dream to have interest-free income. And then there was one unbidden marketing. They were travel agency going for Hajj and all those. They were taking people for Hajj. And the gentleman Sayyid Farid, he has sort of befooled people in parting with around 1,000 crore rupees. So this has happened over the past 1 to 2 years, 3 years in all those. So what I'd like to understand from you, I mean, whatever you wish to, definitely you will speak, as is the funding requirement of Tamil Nadu. What I'm telling is that any funding requirement, part of it comes from government. Like so far for Tamil Nadu state, almost 55% is being funded by government. Part of it comes from investors. But isn't it that a significant part of domestic investors is not being channelized because of their, faith? So what shall we have the benefit of the lawmaker also here? What shall we look into those areas also? I'll be very happy if you could just touch upon those areas also. Over to you, Rafi. Thank you very much.
Thank you, Farooq Saab. Assalamu alaikum and good afternoon to everyone. First, I would like to thank UF and the President, Mr. Ahmad Buhari, for inviting me. I think this is the third UEF event that I'm speaking. I'm quite delighted that we are focusing on the opportunities of financing growth in Tamil Nadu. As you know, I'm not that familiar with the opportunities in Tamil Nadu, but I think the key message is where are the sources of funds coming from and what these sources of funds are looking for. I think that's more critical. So that Tamil Nadu, despite the challenges that we are facing in India in general and Tamil Nadu in particular, like mentioned by Mr. Rajan, on weaker institutional framework that may hinder some of the global investors and foreign direct investment to come to Tamil Nadu. But if you look at the landscape, what these funds are looking for, and if India can prepare itself to be the beneficiary of these funds, then there is greater chance of getting FDIs into India. So I would like to quickly touch upon the size of Islamic banking and correlate that to another interesting and highly, exciting area of sustainable finance. There are a lot of things in common between Islamic finance and sustainable finance. And if we can, bundle these two together, I think India and Tamil Nadu in particular would greatly benefit from. So if you look at the state of Islamic finance, it's now has spread to over 50 countries. And some of the countries are not Muslim majority, for example, in the UK, in Canada, in the US, and even in India, where we do have Islamic asset management licenses being given, but not so much on the banking side. So in total, the size of Islamic banking is about $3 trillion. But in the context of world finance, it's still very small. Mr. Bond was mentioning about the size of the financial assets, around $300 trillion. Global Islamic banking is only 1% of that. So the size is still very small. But as I mentioned earlier, if you can combine Islamic finance, because the principles and the aspirations are quite similar to global sustainable finance movement, then suddenly the pool of investments and sources of funds available grows significantly. So if you look at the two sources of funds allocated for sustainable finance, one is the United Nations PRI. What we mean by PRI is the Principles for Responsible Investment. UN PRI is a global movement, and as of November this year, they have garnered 3,000 signatories. And many of the signatories are large fund managers, wealth or reserve managers, pension funds, both private and public. I don't know whether Indian pension funds have signed up, but certainly Malaysian pension funds, both private and public, have all signed up. So what does this mean? When 3,000 signatories signed up to this United Nations PRI, the UN PRI requires these signatories, and in total, these 3,000 signatories are managing $100 trillion worth of assets, financial assets. That's 1/3 of the global financial assets. So these signatories are committed to migrate or shift their asset portfolio towards sustainable portfolio. What we mean by sustainable portfolio is, if let's say they've invested in coal-fired power plant, by 2030 or by 2025, they have certain timelines, they will convert to renewable energy. So that means they will be shifting towards more sustainable portfolio. So these 3,000 signatories, like the global Islamic financial investors, have all signed up to beyond profit aspirations. They're not only, of course, profit is an important element, but they want to grow their portfolio for impact, for purpose. So it is profit and planet and people. So they have all subscribed to SDGs in meeting the target. So for example, my own group, CIMB Group, the second largest banking group in Malaysia, we are present more than 10 countries, significantly present in ASEAN. So we have signed up to UNPRI because we are not a fund manager, we are a bank. We signed up to UNPRB, Principles for Responsible Banking. So like PRI, PRB covers the banking sector. UNPRB now has 200 signatories with $53 trillion under management. So what does it mean? When $100 trillion worth of investments have been allocated, they're now looking for investments to invest, opportunities to invest into. So they'll be looking at India, they'll be looking at other countries to see, are there impactful investments in India? So if India can come up with a list of opportunities that can meet the targets of the investors, that's a win-win situation. Today, although $100 trillion worth of investments have been earmarked to be shifted towards what we call Islamic or sustainable finance, only 1/3, about 30, less than 10, 20 trillion have been now invested. That means if you look at the pension funds in Malaysia, the UNPRI, and they have milestones to meet. But in terms of investment opportunities in sustainable finance, sustainable investment, the opportunities are still far and few. So therein lies the opportunity for Tamil Nadu to come out. Instead of going for traditional investments in ports, seaports or airports or power sectors or roads, why not look into renewable energy? India has a huge talent pool. Mr. Rajan talked about few 100,000 engineers coming out every year. And Mr. Ahmad Buhari talked about, the Biryani lab. Why can't we have similar labs, renewable energy labs in universities, targeting, for example, small hydro. India has huge hydro opportunities. Can India become the pioneer for small hydro renewable energy? It doesn't require billions of investments, but whatever investment you need, there will be huge appetite. Because, fund managers in Malaysia, in ASEAN, in Singapore, all of them have signed up. And every year we are supposed to show progress. But if we are not seeing investment opportunities, we will be lagging behind against our commitment and milestones. So all I'm saying is, even though India may have what we call weaker infrastructural investment environment, it doesn't deter investors to come if you have unique solutions that could meet their targets. So renewable energy across wind, solar, geothermal. In India, there are about 350 sites that have been identified with potential geothermal energy usage. But we have not seen significant innovation coming out from that. Biomass is a great example. Today, landfill is a major problem in every single country. If India can come up with a solution, right, cheaper, better, faster, in terms of converting this biomass into energy, sustainable and cheap energy, that's a win-win situation. Investors will come and put money here. What about water? Today, there's a huge problem. Chennai, I've read about water problem in Chennai. Is there a way to solve that in a most efficient manner? Water and sanitation, clean water and sanitation. The other area is food and agriculture. Today, under SDG 2, Sustainable Development Goals, the UN is promoting what we call food security and food sustainability. Is there a way for India to become a market leader? We talked about Israel. I think Ahmad Buhari talked about Israel being innovative. Israel has been extremely innovative. They have now introduced what we call re-milk. They have restructured milk using cultures within the lab itself, where you don't need cows to produce milk, right? They have now produced 3D printed meat made of vegetables and soya. So we are now seeing a lot of innovation coming in the food and agri. Forestry is another example. I have another minute. So forestry, for example, in India, Ayurveda is really thriving. Can we bring this Ayurveda as a complementary, holistic solution to the world? Again, India is a leader here. And you look at transport, electric vehicles, charging infrastructure. Can we have efficient energy storage, smart building? These are areas I think it doesn't require huge amount of investments, but potentially you can have 100 unicorns coming from Tamil Nadu alone. If you can look at all these sustainable development sectors, whether it is renewable energy, energy efficiency, clean water, sanitation, food and agriculture, climate change mitigation, forestry, and alternative land use, and efficient transport, these are areas where it doesn't require billions and hundreds of billions of investment, but it needs a lot of brain power. And I think India has that. I think that's where Islamic finance and sustainable finance can come in. Let me just recap. Islamic finance is just $3 trillion. But if you combine Islamic with sustainable finance, that's $100 trillion worth of investments that have been earmarked, that have been promised to be migrated toward sustainable development goals in 10, 15 years, depending on the targets given by the fund managers. So India should just capitalize on it and say, guys, you're looking for investment, these are my solutions. And I think that will be a big impact to India and the world in large. Thank you for the opportunity, Farooq Sahab.
Thank you very much. Thank you very much.
And on the last point, on these Ponzi schemes, right? If you leave a vacuum, someone is going to fill it. And this is what the UK government, the US government, the Canadian government has done. In order to make sure the economy is, chugging along full capacity, you need to make sure you don't have these pockets of, savers or investors who want to invest according to their faith, according to their belief. So UK has already come up with ways of making sure that these funds are managed according to their faith, and that will go back to the economy. It will make India stronger if you're able to manage these funds according to faith-based or according to what we call ethics-based. And that thereby you can avoid these Ponzi schemes, because currently there's a vacuum, and these vacuums will be constantly filled with people with all kind of bizarre schemes to cheat the people. Thank you.
Thank you very much. Thank you very much, Mr. Rafi Hanif, for your very comprehensive coverage of the topic. And now we'll take questions. So one question which I have received from one of the audience is to Mr. Tyagarajan. As a finance professional, you have been a finance professional, so although you are in politics, still you will continue to be asked about finance also. So as a finance professional, what are significant financing sources which should be tapped by Government of India to meet various financing needs of the country?
I think there are really only 3 or 4 or 5 avenues. Of course, the equity markets are relatively well functional in India. If anything, they may have a bit too much velocity, too much hot money comes and goes. But relative to the rest of our economy and our financing platforms, the equity markets seem to be reasonably well done. The debt markets are woefully inadequate. In my experience, globally, the debt markets in, say, the US, which account for 80% of all corporate financing across all tenors, I'm not talking just infrastructure, and 20% come from the banks. And that's the way it should be. The banks are not intended to do term financing. They have basic asset liability duration mismatch. So clearly, the first place they should look at is improving the debt markets. But, let me go a bit technical, then I'll go a bit philosophical. There are, of course, many opportunities to set up special purpose vehicles for specific projects or specific areas. There's been some success with those, but those need to be set up with great transparency, with enough accountability, and with kind of guarantees that are enforceable in a system other than just the court system of India. So, for example, at different points, we had recommended having maybe offshore jurisdiction-related documentation where you agree to take the arbitration to an international jurisdiction without going to the Indian courts first. There are any number of special schemes to tap non-resident Indians and to tap the kind of patient capital that could come were you to provide, again, the right framework and the right structure. Finance is infinitely creative. I spent the bulk of my years on Wall Street going through the kind of boom in derivatization, securitization, globalization. And, you can make anything look like anything. You can make any document custom to any risk return profile or any product. The underlying philosophy is much more important to me. And I couldn't agree more with Dr. Stiglitz that what you do first is you build investor confidence. You build investor confidence by showing them that you understand the value of transparency, of communal harmony, of consistency, of continuity of policy, that you don't come kind of rip up the whole place and anything can happen any day because I say so. You respect the democratic institutions. You respect the process. You give comfort that you are a thoughtful, kind of reasonable person who will not create risks that have not been envisioned by investors. I had the luxury of personal interaction with one of the top 3 or 4 bureaucrats in the financial department of the government of India, who's a Tamil Nadu cadre. And there are learned people, who are very clearly capable of conveying this message and kind of working closely with big asset managers and fund houses to ensure that there is a ongoing and continuous relationship, but it has to be based on the right philosophy of governance. So the biggest concern I have about India today is not where the avenues are or which products or which sources, whether it's the 3.3 trillion of funds in sovereign wealth funds in the Middle East, which are relatively patient capital because they're not planning to run them down anytime soon, or the big pension funds of the Norways or the long-term insurance actuarial investors, as you said, including our own Provident Fund. What I find missing is a connectivity between policy and creating environment for growth. So I worry that the government's basic approach to electoral politics is far ahead of its approach to actual governance, building the relationship with the global investment community, creating the comfort that allows you the flexibility to operate. Take, for example, I'll give you a very clear example instead of just talking in theory. We are now in a very dramatic kind of bind because we have the worst economic recession, at least in documented history of India as a country, when the government's finances were already in a very big mess because they had been mismanaged, in my opinion. But yes or no, self-inflicted or not, the net result was prior to the onset of COVID, the government's finances were already in a pretty big mess. And you now are hit with the need for fiscal stimulus. There's only so much you can do with monetary stimulus and with the Reserve Bank and all that. You have fundamental fiscal stimulus issues. And the government seems to be caught between a rock and a hard place. On the one hand, they worry a lot about their rating, which is just hovering above junk grade, and are worried that were they to run deficits, where would they finance them, what would happen to the kind of bond coupon rates, and what would happen to its rating. On the other hand, by not providing the stimulus, by keeping on delaying and saying, I'll wait and watch and wait and watch, you're allowing the hole to dig deeper and deeper. Anybody who understands anything about economics says that if you want to nip this in the bud, you do it now. You don't do it after the economy has gone down -10, -12%, where the hole is so deep that you cannot fill it and come out quickly. But the point is, if you had policies that inspired confidence, if you had the relationship with the rating agencies and the big funding agencies that inspired confidence, if you gave them the comfort that there would be continuity in your policy, that there would not be dramatic breaks, that you understand what you're doing, that you have a plan to fix your tax hole within the next 3 to 5 years, and that this is a temporary blip, that you know what you're going to do in terms of asset disposals, what are the values, you're going to run them transparently, you're going to accrue full value out of them, you're not going to allow crony capitalism to develop, then you can get the funding that you need and you can do the deficit financing or the monetary, you can do the money printing that you need, the deficit financing out of the bank without affecting your rating. I mean, these are the rating agencies that allowed what looked like AAA papers that went down to 20 cents on the dollar in 2 months. So it's not like these rating agencies are like, the most tight, strict, never make a mistake, always conservative agencies. You can sell anything if you have the right kind of, credible evidence to sell that. So I worry that without fixing the philosophy of the government's approach to administration, governance, the economy, and how people should be treated and where institutions should be built, it is not that simple to go and start selling products, right? I mean, it's amazing to me that when there's trillions of dollars of excess liquidity, if we look at the total central bank pumped out liquidity after 2008 to today, it is mind-boggling. We're not living in the same world anymore, right? What happened before 2008 and what is out there today is trillions and trillions of dollars of extra capital, interest rate 0 or minus in many parts of the world. And here we are saying, I'm worried whether I can do 2% of GDP stimulus or 5% of GDP stimulus in a country where the GDP is only about 2.7, 2.8 trillion. So there's a fundamental disconnect, it seems to me, between a professional perspective on what it takes to actually create comfort, create a story, create the kind of environment that attracts investment. And therefore, you will have almost unlimited access because the scale of India's needs relative to the global glut in liquidity is tiny, is small. But here we have people who are so worried about these little things and don't think about the philosophy. So, of course, there are hundreds of products and avenues. If you don't have the philosophy right, if you don't have the framework right, you're going to have a very difficult time attracting anything other than hot money that flows in and out in a kind of equivalent of global day trading that comes and goes.
I'm very much with you, Mr. Tyagarajan, because, is that this first half of this financial year, that's April to September, it's said that there's global glut of liquidity. So what's happened that $39 billion has come to India, by way of FDI, and most of it's gone, as you all know, into equity buying. So will they be translated into investment in Indian geography? That is to be seen, and what impact it's going to make. Second question that has come to me is also very interesting, and probably it is addressed to Mr. Rafi Hanif, but Tyagarajan Saab can also, because it's related to him also, The question is that considering the large investment in infrastructure for Tamil Nadu in next 20 to 30 years, how can Islamic Bank help? Is there any other developing country where Islamic banking assisting in infrastructure investment? So this is question to Rafi, but what I'm telling is that to Mr. Tyagarajan also, that can we think of something, some nascent step, maybe a step for Islamic banking or Sharia-based banking or ethical banking or participative banking in Indian economy also.
Yeah, why don't I defer to Mr. Rafi first, and after that.
Yeah. First, Mr. Rafi, yeah.
So in infrastructure space, what we have seen in most developed and developing countries is typically infrastructure investments are funded through domestic financial institutions, predominantly. You would have a combination of funding. For example, you have equity coming from the sponsors, and the sponsors could be both local as well as foreign corporates
Yeah.
who might have a JV to run the plant or project. Then you would have, for example, development funding. It could come from Asian Development Bank. Some of it could come from, if it's Islamic Development Bank. But bulk of the financing will come from commercial banks. And given that most of these large infrastructure projects will be denominated in local currency, like for example, your roads, your power, all this will be in rupees. You're not going to bill in dollars. So in most countries, we typically see the local financial sector supporting the infrastructure play. So in more developed countries, and if you look at Malaysia, which is quite developed on the bond market side, we can do now almost all our infrastructure investments domestically funded. So we have done 30-year bonds, sukuk, Islamic bonds, which are basically driven by the local institutions and funded by the pension funds. As Mr. Rajan pointed out, for you to grow your infrastructure, you cannot rely on bank funding. Given Basel III requirements on liquidity efficiency and liquidity management, it's very difficult for banks to do longer tenor. And infrastructure space require 20 years, typically 15, 20 years funding space. So what we have seen, most countries today are relying on the fixed income capital markets to finance, which is the bond market to finance infrastructure space. And in Malaysia today, we don't have any more bank loans financing infrastructure space. Probably in the last 10 years, I've not seen a syndicated loan for infrastructure projects. It's all driven by the bonds. And today, in the bond space, just to give you the color, almost close to 100% of infrastructure today is funded through Islamic bonds. Because when we do Islamic bonds, we are able to cater for conventional investors as well as Islamic investors.
So this is what I'm telling you that, yeah, sorry to interrupt you. Please go ahead, then I'll put my question.
It's more inclusive. So if I'm an issuer doing a road project or a power project, I rather prefer doing Islamic bond because I cater for both investors. If I do for conventional, I isolate the Islamic investors because conventional investors are agnostic. They can invest in both Sharia compliant funds and conventional funds, but Islamic investors can only invest in Islamic bonds. So therefore, most issuers today typically just default to Islamic bonds. And all banks today in Malaysia, whether they are government-linked banks or Chinese-owned privately run banks, they all have capabilities to do Islamic bonds. So that's the advantage of.
Yeah, my question was that as you are telling that sukuk is, is that agnostic to whether it's conventional or whether it's Islamic and all those things. So can't Indian infrastructure projects could be financed through sukuk?
Sukuk is nothing but a trust certificate. It was actually designed as a trust certificate, right? Muslims happen to call it sukuk, but if you look at the offering circular, the governing document that lists out the bond structure, it actually says it's a trust certificate.
Yeah, it doesn't say sukuk. Underlying securities and all those are there. So
yes, that's what I'm saying. India, being a common law country, can easily issue a trust certificate. I don't see any issue. Now, the thing is, who are the buyers, right? If I'm an issuer in India, issuing a trust certificate called sukuk, I must have a target investor base. Now, in Malaysia, I'm happy to use it, issue it because there's a huge investor space looking to invest. So it's a chicken and egg situation or catch-22 situation where you can't issue a sukuk until you see the demand for the paper. So you need to build up the demand.
Another question to Mr. Rafe, I'd like to, Mr. Tyagarajan, will you like to say anything?
I think Mr. Rafe has made the very clear point. I mean, we were a significant issuer of sukuks in Standard Chartered Bank. We had Islamic financing department both in Dubai and in Singapore and in KL. And, many of those bankers were my friends. So I completely agree that there's a natural kind of synergy between the nature of trust certificates for sukuks and for infrastructure projects. I would just add one more thing. I would say that, from a investor comfort perspective, and I think most people know this, but grant me the indulgence of going back to basics. When we used to see the big high-yield bond and high-yield leveraged loan issuance in the U.S., there was, at least in normal times, a kind of ratio of bonds to loans that made sense. When you looked at high leverage, high yield, high risk, high return investments in the fixed income space, there was a natural kind of bond to loan ratio because the bond investors relied on the banks who were inside lenders to keep a track on the cash flows and the day-to-day liquidity and make sure that the projects were running properly. And the banks liked that the bonds took the bulk of the volume risk because of single borrower limits and duration limits and all that. The banks didn't want to be 100% in the issue. So there was a natural issue where you had a component that was syndicated loans so that the banks did their part of the value add, and then the rest was with the markets because the markets have infinitely more volume and duration capacity than banks. I use this as an example to say, this is how you're supposed to think creatively about financing. In a place where you worry that the judicial system and the institutions of government and timely resolution of should risks prevail and should investments fail, you can actually structure these in such a way that it gives comfort to the investors. So you don't have to have them all as equal kind of pari passu risk in the investment. Places like India, the government can take certainly some of the kind of first class risk because the government has the capacity to ensure the success of the project. Most of the problems are regulatory and rent seeking and corruption and things like that. So you can easily structure investments in such a way that there's a small role, but a significant kind of gatekeeper, policeman role to be taken either directly by the government or by government funds or government agencies or government infrastructure, third-party funds. And then the rest can be put out to the market with the comfort that there's skin in the game for people who will make sure it goes right and who have the capacity to make sure it goes right, which investors may not have, particularly market investors are in the public markets and neither have access to timely information, nor do they have access to counteractions should things start to go bad. So I think there's a lot, the kinds of financial engineering that were used at the height of the kind of derivative bubble, if you will, between, let's say, 2001 and 2008, those notions of the sharing of risk and responsibility at different tiers to different people, of waterfalls of return and risk, are easily adaptable to these kinds of projects. And you can profile different kinds of tranches of risk for different investors and make it more attractive. And the whole is greater than the sum of the parts, in at least in my understanding of the world.
So thank you very much. It's now almost the time to close, but before the closure, I have got 3-4 interesting questions, but I found one question very interesting, so I'd like to get a reaction from you, is that as you're telling that bond market is going to take some time in developing, in India. So is the case with other kind of things, that PF funds, actuarial funds and all those things, how it is going to take shape and all those. We are telling about governance, etc., the issues, judiciary, resolution processes and all those. So the question is, are we looking at rebirth of developmental financial institutions as it were earlier? ICICI Bank was earlier ICICI Developmental Financial Institutions. IDBI Bank was earlier IDBI Developmental Financial Institutions. So do you think that in the days to come, because banks are very, facing its own problem on the ALM front and all those things, and huge NPA, etc. Do you think that these DFIs are going to be revived in days to come?
Yeah, I think actually by coincidence, I was quite engaged with the last stages of the cleanup of the Japanese banking system as advisory bankers and structurers that Lehman was. When, what were 42 or 43 banks in 1990 collapsed down to the three mega Japanese banks we know today, the Mizuho, MUFG, and Bank of Tokyo Mitsubishi Group in 2004 or 5. So I believe that without that kind of a directed strategy, including the creation of one or more bad banks and the actual matching of books and exposures and the removal of concentration risk, I think you need an active hand to resolve the banking crisis that is in India today. I don't think you can leave it to kind of market or, ever so often infusions of equity from a government whose balance sheet is already stretched. So in the sense that I believe that structural reform of banking is necessary, then I believe that this is a golden opportunity for you to also start carving out different roles for different banks and start kind of envisioning, the whole point of finance. If I go back to my, first principles, where I was very fortunate to start at the MIT Sloan School from so many eminent economists. The whole nature of the financial services industry is simply to move money back and forth in time, right? Is to take when you are in need of it so that you can borrow. And for most of us, we start putting away money for retirement for a later day. Some in small scale, some in big scale. And then, of course, you have ultra-rich people who only do investment for investment's sake. But the nature of the financial services market is to move money across time. The vehicles that are used and the nature of those vehicles and the relative ratio of those vehicles will surely change if you need optimal outcomes. And so at different points in time, I think these industrial kind of frameworks will have to be redefined. And I think India is at a point where Japan once was, to a lesser extent, the US went through after 2008, and it may not be fully done yet. Europe is going to have to face its own day of reckoning. It's done some, it's still got a lot to do. India's got a whole lot to do. And I think clearly these kinds of prospective benefits should be included in the mix when this restructuring is done.
Yeah, Rafe, before we close, one question to you. It's an interesting question, so I couldn't resist myself. The question is that, is that pandemic has been quite problematic for people in general and business in particular. So it has thrown up a big payment risk for the banks. So what other banks, banks in other countries have done. In India, what we have done is that for the past 6 months, no installment was taken from all the pandemic impacted businesses, and there was no compounding on interest from them. So since, say, 29th February to 30th September, that was the case. But 1st October onward, everything comes up as payable. So what has been done by other international banks in different geographies? What are your experience on that?
Yeah, so we are not too different from what you have said earlier. We have also gone through what we call a compulsory moratorium. So since March till September, all these financing, can you hear me?
Yeah.
All the financing were literally put in abeyance for 6 months. So people only started paying in October. But since October till December, we have gone through targeted moratorium. Targeted means those who are vulnerable segments. For example, if you are in tourism, hospitality, and certain other vulnerable segments, we have given what we call a targeted moratorium. So during this period, it could be 3 months, could be 6 months. Some we have even extended longer. There will not be any compounding effect. Obviously, the financing has to be repaid, probably with a longer tenor. And some of those financing today, we are already doing the R&R. So we are restructuring it to even longer period, because we know this is not going to be solved next quarter. We believe that the problem will only emerge next quarter. The first quarter next year, I think, is when the movie will begin. So 2020 is when we've been playing the trailer. The movie is going to start in January, and that's where I think a lot of businesses will face huge headwinds in terms of managing the cash flow.
I just pray that the movies are not horror movies.
What the government is focusing on is to make sure to give a bit of breathing space, allow job security. That's most important part.
Most important.
So give all kind of breaks, all kind of support to ensure that people are still employed. And banks need to be more flexible in terms of giving a longer tenor restructuring. That's the best we can do now.
So thank you very much. Thank you very much for such lively discussion, and you took all the questions head on and explained your views in a very eloquent fashion. Thank you, Mr. Tyagarajan, and thank you, Mr. Rafi Hanif.
Thank you so much. Have a pleasant day.
Take
care.
Have a pleasant day. Thank you very much. Bye-bye.